Good morning, everybody. My name's Greg Gens, and I'm an area president with Focus CFO. I welcome you to the TEI President's Forum panel discussions on getting your M&A plans back on track, particularly during COVID. I'm encouraging you to ask questions either through chat, or if you want me to read your questions, I can read the chat. Or if we've got questions, we have a relatively small group, you can feel free to unmute yourself and ask the question. With that housekeeping taken care of, I'm going to introduce our panelists. We have a great panel this morning with a vast wealth of experience on mergers and acquisitions to share with you. First, I'd like to introduce you to Mark Sponseller, who's worked for 25 years in mergers and acquisitions with corporate banking and private equity entities across multiple industry sectors on many M&A transactions, corporate turnarounds, and performance improvement situations. He's a former partner with PricewaterhouseCoopers and was a managing director at Alvarez & Marisol. He's also held principal roles as the chief financial officer, global finance director, and senior advisor and senior partner for a number of closely held and private equity-backed companies. He's currently the CFO of Prime 360, a Huron Capital-backed portfolio company that is the largest broker of white wood pallets in the United States. He's a partner and owner in Morningside Group, and he's also a consulting member of Focus CFO. We also have Andy Vollmer. Andy leads the Cleveland office of Bellmark Partners, which he opened in 2018. Previously, Andy was with KeyBank Capital Markets, where he ran sponsor coverage, consumer and retail, and mergers and acquisitions. He also served on Key's executive council and as chairman of the investment committee for Key Capital Corp. Prior to Key, he worked in the M&A group at McDonald & Company. He is a career-long M&A banker. Andy has completed over 100 mergers and acquisition transactions, as well as numerous board advisory assignments, capital market transactions. And he's a graduate of Miami University and lives in Pepper Pike with his wife and 2 children. I'd also like to introduce Dominic DiPuccio. Dominic is the chair of Taft Law's Mergers and Acquisitions Group. His practice focuses on mergers and acquisitions and private equity and debt securities offerings. He represents entrepreneurs, emerging growth, and seasoned company investors, venture capital and private equity funds, real estate sponsors, and a wide variety of corporate finance transactions. Dominic counsels buyers and sellers on all aspects of mergers and acquisitions and capital raises, including due diligence, letters of intent, deal structures, pricing alternative, negotiations, documentation, and closing. Dominic also counsels companies, including private placement, including investors and real estate sponsors in a wide variety of private financings, including private placements, angel funding, venture capital, private equity, joint ventures, historical tax credits, and preservation easement financings, and also fund formation matters. And finally, we have Brandon Fredericks. Brandon is a CPA and a principal at Apple Growth Partners with over 10 years of experience in public accounting. He started his career at Deloitte in their assurance and advisory practice, focusing mainly on Fortune 500 companies in the manufacturing and industrial sectors. Brandon partners with business owners and executive teams in an effort to help them achieve their goals through collaboration and execution of their main objectives. Brandon focuses his time on accounting advisory projects, transaction services, financial statement, attest support, risk management and assessment, and data analytics. Brandon holds a BA in accounting and finance and an MBA from Baldwin Wallace University. Brandon is an active member in the Association for Corporate Growth here in Cleveland, which is an organization helping to drive growth in the middle market. He also serves as a chairperson to the Baldwin Wallace Accounting Advisory Board, which helps to promote accounting while preparing students for their careers. Brandon is a member both of the Ohio Society and the American Institute of Certified Public Accountants. With that being said, I'd like to get a few opening remarks from our panelists. I'd like to start with Andy. Andy, can you give us kind of a current state of M&A market right now in light of all the things going on with COVID this year?
Yeah, sure. I'd be happy to. It's certainly been an evolution this year. Pre-COVID, the M&A market was, basically in a white hot status. There's a lot of liquidity and a lot of activity. I think with the shutdown occurring, mid-March, and then into April and May, really limited M&A activity. First of all, many companies were just literally shut down. We actually had 4 transactions that we were trying to close in the back half of March, right in the middle, when all this hit. I'll come back to that later. But really what happened in back half of March, April, May is that debt capital sources dried up. Banks stopped lending money. Non-bank lenders that do middle market leverage deals really stopped. Many of them had their funding sources dry up. But the banks quickly became internally focused, looking at credit migration, dealing with covenant and other restructurings. So the banks had good liquidity, but they just weren't in a position to use it at that time, facing kind of massive credit losses that they were anticipating, particularly, or write-offs, particularly in the second quarter. At that point in time, there were some deals that got done, and basically strategic buyers that had liquidity had a huge competitive advantage, I would say in the second quarter. As we got into July and August, the market became somewhat functional. Many companies had sort of reopened in different parts of the country, but depending, would have an impact on the exact timing of that. But many businesses that actually were essential businesses that stayed open the whole time still had dramatic reductions in volume. In April in particular, things started picking back up in May, and that improvement continued into June and July. As I mentioned, we had 4 deals that we were trying to close at the end of March. One of those closed in mid-March. The other 3 all got delayed because of COVID. Now, the good news is we were able in June to really get those conversations, sort of reinitiated, and we were able to close all 3 of those transactions in July. But I would tell you that all 3 of those were literally in the red zone to close at the time the COVID shutdown hit. But over the summer and into Q3, I would say M&A markets were still challenging, primarily because of really a lack of middle market leverage finance product out there. Banks were still reluctant to lend, very uncertain about future cash flows and other reasons that they were not willing to lend. We did see some of the non-bank lenders, the direct lenders, come back into the market in Q3. Post Labor Day here, I'd say the lending has basically to really have a vibrant M&A market, you need to have really strong conditions in middle market leverage finance. And, those conditions improved significantly post Labor Day. Banks were back in business. The direct lenders are back in business, although with some modifications. I would say just at a high level, less leverage, so less debt on a given company at a higher cost. So it's functional, but there has been a cost. I think given the change in short-term interest rates too, banks have reinstituted LIBOR floors on leverage deals, and also just generally higher spreads, 50 to 100 basis points higher than what we saw pre-COVID, and probably a half a turn to a full turn less of leverage based on EBITDA than what we saw pre-COVID. So overall, we have seen a number of new deals that hit the market post Labor Day, anticipating improved market conditions. I would say the vast majority of those deals were slated to go during COVID and just got put on hold. I would say generally the market is better, but there just is not enough deal flow out there, given the amount of liquidity that is still chasing deals. So, my quick summary is, if your business rebounded quickly from the shutdown, and you're today back at your pre-COVID levels in terms of operating performance and growth trajectory, I would say it's a very good time to look to do something. If you're still off somewhat or you haven't recovered to your pre-COVID levels, which is certainly understandable given where the economy is, it's hard to get lenders and acquirers to basically look through that COVID shutdown period in your financials.
Mm-hmm. Great, thank you. Dominic, when is it a good time to start looking at M&A as a growth method for a business owner? And does the COVID pandemic change that?
I think the COVID pandemic does change it. I think the analysis is a really kind of a simple one, but it's a very specific one depending on your business and your industry. I think there's maybe a half a dozen sort of big picture considerations, and each of which has some sort of sub considerations. But the biggest consideration really is, what is your goal as a business owner? Are you building a lifestyle business? Is it a family business? Or are you trying to grow something that you can later exit and sell and sort of retire? So it kind of depends on what is your plan? What is your intent? A lot of people who are running family businesses or sort of what I'll call lifestyle businesses, an M&A strategy may not be the right strategy for them. Secondly, how do you feel about having investors? How do you feel about having partners? How do you feel about putting debt on your business? Because if you are thinking about an M&A strategy to grow, you're going to need the capital. And unless you have sufficient cash and you're willing to sort of invest all of your cash into these initiatives, you're going to need partners, or you're going to need investors, or you're going to need a lender. And it really depends on, you have to ask yourself, how do you feel about that? How do you feel about investors that are going to be, potentially, in your shorts all the time, asking questions and bugging you for information and second guessing your judgment. So you have to ask yourself whether that's for you. Thirdly, really externally, is market conditions. What is your industry that you're in? Are you in a fragmented industry? Is it one that's maybe ripe for a roll-up, ripe for consolidation? If so, then an M&A strategy might be the right strategy for you. Are you in an industry that's flourishing? So, for example, to your COVID question, we all are realizing that a lot of businesses are actually thriving during COVID. And if you're in one of those industries, maybe an M&A strategy is right for you as a way to accelerate growth. So you have to look at your industry and where is your industry at sort of developmentally. And lastly, sort of business conditions. What are the specific business conditions? Are you an attractive buyer? If you're doing an M&A strategy, are you thinking about using your equity as consideration for your acquisitions? If so, are you a strong company? Do you have a big plan? Do you have something that sellers will be interested in? Can you compete with other potential buyers in a competitive marketplace? So you have to sort of ask yourself, how do you look as a potential acquirer? And lastly, how are you performing? And how are other businesses performing? Is it a time where you may be able to take advantage of an industry where people are kind of hurting and businesses are down, and maybe you can get good deals? Or are you competing with other buyers for sort of the best of the best? So I think you have to ask yourself all of those questions. It's different for everybody, both specifically for your business and generally for what the market conditions are.
Okay, thank you, Dominic. So Brandon, in all this craziness going on, doesn't it just make more sense to let the world go back to where we knew it and the new normal? And do we have, when will this COVID pandemic be over in the M&A scope of things?
Yeah, glad you qualified that. We're not chasing down the news tabloids or anything about when COVID will end, but kind of like looking at it from my position, right, as a due diligence, a person that kind of executes a lot of quality of earnings, really kind of helps supports a lot of the stuff that Andy and Dominic and Mark kind of do. the way I kind of look at it is, Albert Einstein says that with every great crisis, lies a great opportunity. And that's why we kind of look at some of this stuff. And in the spirit of Halloween coming up here, obviously we got to have our spidey senses up, but there's an opportunity to kind of be really smart here. And we just talked about, how volume is down, how we got some different type of financing and debt items out there kind of in the market space that are having some constraints to kind of getting some of these deals done. But if we're smart about the approach and our plan, which I'll highlight here in some multiple different facets here today, deals can still get done. Really need to ask better questions and different type of questions. Things that may not have been extremely relevant in prior periods are now extremely important in terms of how business is getting done, in terms of how new revenue streams are operating, where they're doing, supply chain, a lot of different ways from how the COVID's impacted and how they're recovering definitely are coming into the different conversations, why they're going to market. A lot of different things are being asked, obviously similar type of questions, but just kind of in a different manner. And then just lastly, the approach to how we kind of do a lot of things. With everything kind of being shut down, everything's always remote. So how does that look? You have a lot of deals kind of getting extended. A lot of these things are being done remote. So how do you kind of fit in terms of the culture? How do you kind of execute a lot of the due diligence? I think the thing we've really tried to embrace with a lot of the deals that we've tried to help get over the finish line or trying to start back up here is really kind of embrace this process, be open to this process, be creative kind of in that space here, because we keep talking about the new normal. This is the normal now, so it's just trying to continue. How do we get back on track here? Continue to kind of move the markets in that direction.
Okay, thank you. And finally, Mark, COVID certainly put a big wrench into everything, and an M&A process usually was kind of fraught with peril for people who are not new at it. Are there any subtle issues that or traps for the unwary that I like to call, that are out there that you see now that have been pushed to the forefront because of COVID?
Sure. Yeah. I think to kind of echo some of what's already been said, history obviously is not a good predictor anymore. And typically, I was a diligence. That was my main line of work for, kind of 18 years of my 25-year career. And you kind of always predicated on understanding the history and then using that as a predictor for the future. I don't think that's, where we are. The kind of quote unquote new normal is likely to be here for a while. And so while traditional diligence approaches are certainly relevant, there's a couple things that I think we would look at when we look at companies, just given our own business, that perhaps we wouldn't have even evaluated in the past. And kind of off the top of my head, someone touched on it earlier, and I think it was Brandon, but this whole ability of flexible work arrangements and working from home, not everybody is equally good at it, but we're all going to be kind of stuck with it to varying degrees, I suspect, for a while. You really need to evaluate, is it someone who's just saying, okay, well, everybody work from home? That's one approach, versus someone who's proactively set up a task force within their organization that's cross-functional. This is what we did, who are constantly plugged into what are the best practices, what are the issues people are seeing, how is your company handling schools being open, not open, how are they proactively engaging with the workers? Because it's more than just, I think everyone or most people have addressed it from an IT perspective, which is certainly relevant, but have not fully addressed it from a human capital perspective. And I think if human capital is something that's important to your business, you certainly need to, which for all of it is in some regard, even if it's just back office. I think evaluating how effective they are on that basis is really important. And it's a quick discussion. I think in the early discussion of it in your initial diligence meetings, you can find out where they stand by asking a very open question. I was like, how are you guys handling the work from home aspects of your business? And if that's a very short answer, then you kind of have your answer. Secondly, I think in diligence, we've always looked at customers and vendors. And again, it's always in the contextual, context of history. I think you really need to kind of probe around on how proactive have you been on, let's talk about vendors at first, evaluating the financial soundness of your key vendors. I mean, how are you planning for a disruption in operations? I mean, if you're in a manufacturing business and you're getting things from overseas, or if your distribution business getting things from overseas, how are you addressing that? Are you seeing a lag? What happens if, certain ports shut down? Just understanding how they've worked through that and what's their action plan is important. Again, I think it's in the initial stages of the conversation, you ask open questions, and the level of detail you get in response will tell you how detailed their plan is. And then on customers, I mean, good customers can become bad credits now. It really depends. So while our industry is very good because we're tied largely to grocery and drug, and those channels have done well, the realities are, that we're still tied to other, retail channels and other channels that historically customers who've never had credit exposure, or at least not from our perspective, we now have to monitor a little bit more closely, particularly in the middle market. And there's the obvious ones like restaurants and, entertainment and things of that nature, but I think there can be less obvious ones as well. So I think, again, the question is, what kind of system do you have in place? How are you going through this, methodically? How are you changing your approach on issuing credit limits? Are you using this as an opportunity to get a better understanding of your customers' credit worthiness? These are things that people should be doing. I think, to some extent, with the trillions of dollars that have been pushed in the economy, we're still not really where a normal is anymore. I mean, there's still been a lot of, that's a lot of economic boost to the economy. I'm not sure it's sustainable over the long run. And I think, what you want to find out is who are the players who are really evaluating their operations and how to operate under this new normal versus just kind of taking quick, changes and not really changing processes.
Great. Thank you very much. Now, to all the people who are not panelists, I encourage you either to give me questions through chat, or if you want to just speak up, feel free at the end of any one of these. I'll stop every few minutes and give you opportunities. We do have some questions that have come through in general, so I'll go back to Andy. How do I ascertain value if my business is not currently profitable on a standalone basis?
Well, that's always difficult. If the business is not generating profitability or cash flow on a standalone basis, there's always alternative. You look at the value of the assets, net assets, and things like that. But really, in that situation, I think the way to maximize value is to really think about how you could present that business to strategic buyers on a fully synergized basis, and we do that quite a bit. In fact, some of our processes, our buyer audience is strategic buyer only, and so what we will do is present a contribution margin or a contribution EBITDA analysis that we will present to the buyers, and essentially what you're doing is you are quantifying some, maybe not all, of what we expect the buyer synergies to be, and asking them to bid based on that. And so that's really one way to now if you're showing somebody a contribution EBITDA or a contribution margin, it's not the same multiples that you would typically throw around when you're talking about standalone adjusted EBITDA and things like that. Everyone likes to talk about EBITDA multiples, but if you can go to a set of strategic buyers and you've already quantified again some, but maybe not all of the synergies that they're going to have if they buy the business, and you run a process based on that, I think that's generally the way to optimize the outcome and the valuation.
Thanks. So that just kind of makes me think about the legal end of this, Dominic. How do we try to enhance value by looking at the intangibles? And what do we look at to make sure that we get that intangible valuation as high as we can?
So I wanted to first tag along what Andy said, because I think it's possible, particularly with early stage companies, that you could have a tremendous amount of value even if you aren't making any money. And the reason you might have tremendous amount of value is, in addition to what Andy said, that you might be a very attractive asset as a tuck-in to another company that's looking to maybe get into that space that you're in. But you may have a path forward, right? You may be able to tell your story, which is, while I'm not making any money now, there is a path to profitability, and it's going to take time and it's going to take investment. And if you can sell that story, then you clearly have something of value. And to your question then, Greg, is the intangible value, like sort of intellectual property, if you will, is really hard to measure. But we see it all the time. We saw it in the sort of .com era, and we're seeing it again now in all of these different sort of different apps and different business models based on community sharing, like Uber and things like that. And none of those companies made money in the beginning, and some of those companies still don't make any money, but they're valued in the billions of dollars. And that's because they have intangible value, and maybe they have a network of a couple 100 million users, which anybody else would love to plug into. Maybe you have a really slick technology that you have a patent in that you're exploiting in your particular field of use, but maybe it has value in other fields of use, and therefore your patent may have tremendous value to a third party as a licensee of that. Intangible assets come in lots of shapes and forms. Obviously, you have patents and you have copyrights and you have trade secrets and things like that. It's important if you're a company that is going to be what I would call intellectual property intensive, and let's say you have patents that you think are going to be very valuable, then it's important to make sure that on the legal end you have all your ducks in a row and your patents are clean and all of your assignments are clean. And you may want to think about how you hold those. You may want to think about lots of companies hold their intangible assets in separate entities to give them the flexibility to be maybe license those to third parties without sort of mucking up their primary business. So there's it's very fact specific depending on what type of intangible asset you have. But sometimes it's a nice tag on to Andy's question that sometimes that's where the value is. It's embedded in the intangible assets, and it may not even lead to profitability now, but ultimately your story has to lead to profitability one way or another.
Right. Well, I'll just pony onto that. I was involved with a business that was very fortunate to have some products, okay, and some wherewithal and some product knowledge that another company thought was of extreme value, and it added 2 to 3 multiples on what we were able to buy, because to anybody who wasn't really interested in our product line, our multiples would have been in the more traditional range, where we got exceptional multiples for an organization at $30 million. We wouldn't have even been considered, and we were tucked in as part and rolled up as part of another acquisition, and did exceptionally well for what we thought we were going to get. So, I can check onto that. Make sure that you think about, where you might fit in, and you might get better, a little bit better results than you were hoping for. But it's only going to be a very limited number of people who are going to want to do that. So, Brandon, do you have anything to add on, what you would do if you're walking into 2020 as being a down year compared to where you're at, and how do you present that information out to either potential buyers or sellers?
Yeah, I think just a couple things, always going back to that investment theory, kind of what is it that you're trying to kind of propose and go to market with? Where is that value, as Dominic was kind of mentioning? That really kind of all starts early, kind of in the process, something that we try to coach our clients through, whether we call it succession planning or whatnot, but really just kind of the 3 Ps for us in terms of, plan, prepare, and then perform. So as you're kind of going through and thinking about that opportunity that may exist for your business, kind of what's your plan? How are you preparing to kind of go to market? What is that thesis? What background have you and insight have you done to kind of put yourself in a good position? And then how can you ultimately perform? as Andy indicated, how can you show that value, that story kind of to the other person? I think that's what we really try to do with a lot of our clients in that middle market space, that sometimes they may have a little hard time articulating, is over that period of time, putting them in a position to succeed, is really kind of getting all that stuff kind of in order. So when that day comes, when you have that discussion with that potential buyer, you're ready to kind of show them, hey, this is good for you. Greg, kind of like that story that you had, that it made sense from that standpoint.
Okay, great. Mark, you want to pony on to the valuation in troubled times question?
Sure. No, I think, listen, it's kind of relevant for us. Like, I'm on the other side of the table now, and I'm, CFO of a company, and someday we'll probably exit. Who knows when that is? And it's private equity owned, so that's kind of the role. And right now we're in the process of we're trying to predict what 2021 is going to look like. And I think where we've gravitated is, revenues are going to be pretty tough to forecast with accuracy. And I would probably say that most people should avoid the temptation of stretching on that front and really focus in and refine in. I mean, you want goals, you want hard goals, but you want realistic goals, because the worst thing to do is to go into 2021 setting overly aggressive goals on a revenue line that are very tough to make and really can actually hurt your chances of exiting. I think you want something that's sensible and achievable. And where we pivoted, so now we have time left over. It's not that we're not working on the commercial front, but where we pivoted is really the concept of operational excellence. And where can we squeeze more? I think, right or wrong, everyone kind of got fat, drunk, and happy in the last 4 or 5 years. You need to be a tremendously good operator to do well. And that's just some industries notwithstanding, there's a lot. And I think this new world will kind of sort the wheat from the chaff. And I think, so we've looked inside and said, where are the dimes and nickels we can pick up, and let's put those as targets. It's controlling what you can control, doing the best with what you can control, what you control. So like labor, we have a large warehousing kind of management services business, and if any of you are familiar with that industry, the Amazon effect on warehouses and distribution has driven up costs significantly. The COVID effect has driven down labor significantly, and you have a very, very tight labor market in that space. So how do you solve for that is what some of the things we're working on. How do you be more creative? How do you, just don't do it on like, let's keep, upping the wage, but how do we do other things with benefits and with work flexibility and other things, just, retention to kind of manage through that. How do we create greater labor efficiency? And we're doing that through IT. And managing and trying to come up with a more scientific approach to managing labor. We're looking at things like pricing strategy, which everyone probably thinks they do, but I doubt that everyone really truly looks at it. And are we taking pricing where we can, and just being thoughtful about it and not giving pricing up? Because right now, again, I think the knee-jerk reactions, everyone's going to ask for price. We do as well with our vendors. And how do you defend that? And then how do you aggressively go after it? And then, also, I think going down the line, it's indirects and directs, even the less sexy stuff. It's what I call strategic sourcing. What are we paying? We look for everything. Again, it's looking for the dimes and nickels. So, that's been our approach. We're knee deep in it. We're looking at it. We have projected some commercial wins, but by and large, it's a more holistic view of the organization, and probably with a lot more thought on the controlling what we can control aspects in terms of developing the forecast. At least compared to my experience, it's always, forecasting processes have always been very top line focus, and then you kind of, the relationship and dynamics, everything else kind of fall in. I think this is much more of a balanced approach than it has been historically. So if you're going into a deal, don't put forth a forecast that you have no chance of making.
So I do have some questions here. So these will be a little bit less aligned. So I'm going to toss this up and let somebody from the panel take it, because I don't know if we have a real estate expert in there. In valuing a business, how are real estate assets and liabilities viewed? Is it valued only based on the operation side of the business, AKA cash flow?
Oftentimes with, private companies, you'll have, the owners will have set up a separate entity to own the real estate and lease it back to the operating entity. In larger companies, it's a mix. Sometimes the real estate is owned and it's on the balance sheet. In some cases, they're leasing from a third party. I would say in general, strategic buyers, they want to operate entities. They don't necessarily want to own the real estate. In some cases, they do. It varies by situation, and in some cases, owning the real estate can be a very important component. So I would say it just varies by situation, but oftentimes you have a buyer come in and buy the operating entity and agree to lease the operation from either the third party or from the owners of the business. They'll sign a new lease for 7 years or whatever the case may be. But yeah, I mean, in general, I would say strategic buyers, even financial buyers, aren't necessarily looking to pile up a bunch of owned real estate. Now, on larger transactions, you will see financial buyers that actually want to acquire the real estate, because one of the financing mechanisms they'll put in place is a big sale leaseback that'll occur post-close, where they'll be able to really take a lot of the capital they put into the deal at closing. They'll be able to take it out as a distribution on the back end of that sale leaseback transaction.
Okay, thanks. So it's kind of stepping into some of the questions now that I'm seeing are stepping into more of the nature of the transaction. So, Mark, do you see any interesting unique financing terms that are coming out due to COVID?
Yeah, structurally, it's funny. We've looked at some things, and without giving away too much, I mean, we've probably thought more broadly and more creatively structurally on how to get things done, whether it's through setting up sidecar or joint venture type situations and things of that nature, and then more in the infancy, just to try to solve for, while the financing is back, I think to an earlier point, it's higher cost, higher LIBOR flows, less leverage. So I think you have to think more creatively. We're also seeing things. It's interesting. Like I was talking to someone and they were talking about, banks are very focused too. If you're in a refinancing situation, this might be an interesting opportunity for some people looking for M&A. And, it'll be interesting if you have a refinancing coming up. I think it's going to be a very different world than had you refinanced ahead of the COVID curve. I mean, just unique provisions like anti-cash hoarding provisions that put handcuffs on your ability to draw on capital in advance of issues, which everyone tried to do and everyone remembers from the 2008. So the banks are wise to it, and at least we're seeing the larger banks putting that into new financing facilities. So if your existing financing facility doesn't have that, your new one probably will. As well as, I think banks, the more traditional lenders, the ones we all know without calling anyone out, I think they are a lot more concerned about and a lot more focused about, your financial position. Certainly seems to be more proactive. I suspect are likely to pull the trigger quicker than they would have 2 years ago if they're concerned. So, for example, if you blow through a minimum threshold on your revolving line of credit, in the past that might have got you into daily reporting, still will, but now all of a sudden you're probably in workout, and then that's a totally different dynamic with your lenders. So, thankfully we're not in that situation, but I'm just thinking broadly in the market. It'll be interesting. I haven't seen any data, or I haven't really looked, but what the refinance kind of pattern is out there for 2021. It could be an interesting generator of M&A, because where in the past, everyone I think, can probably speak to this, Andy, it wasn't hard to refinance out of the credit unless you were a lost cause the last few years. I think that dynamic could shift in 2021. And so that's kind of unique. It's something that I think could make deals more challenging to get done, but also could spawn opportunities for distressed deals, distressed investing, that, good companies that perhaps got sideways on their balance sheet a bit, but are, intrinsically good, and, create some opportunities for people to take advantage of.
Yeah, I will just double down on that. What I hear when I'm talking to bankers is very different than the kind, and doesn't have anything to do with M&A. It can be just simply you're coming up for renewal. It is a very different world than it was 6 or 9 months ago, and they're looking at things differently than the way they used to look at it, and they're taking extra time, and they're not afraid to talk about the workout word. So,
Yeah.
so. Okay, I've got another quick question coming here, but I'm going to toss towards you, Dominic. This is a little bit tangential, but it's really into how do you start, planning is like, when should I start implementing an ownership transition?
Obviously, I think it's never too early, right? For a lot of people, it's a very emotional decision. Maybe they're considering passing along the business to a family member. Maybe they're just thinking about selling it to one of their key employees. Maybe they're thinking about selling it to all of their employees in an ESOP type transaction. But I think the important point to remember is that it's never too early to get started thinking about what that transition might look like. And I would avoid being paralyzed by not knowing the answer. It's going to be an iterative process. You may today think that the future path towards succession looks like this, but as you evolve, it's very likely to change. So you want to be sort of flexible in how you think about that. But it's never too early to sort of meet with your lawyer, meet with your accountant, and start having these discussions about what are the possible avenues of succession. And with respect to each one, what has to happen? What are the impediments that need to be removed from the conversation? Or what are the challenges that need to be sort of overcome? And start thinking about how to structure that deal. And if you're passing it along to a family member, you're passing it along to a key employee, now's the opportunity to sort of to work together towards that goal. And you're slowly stepping out. Your new owner is slowly stepping in. It does not have to be a finite line in the sand. It can evolve over time. And there's a lot of ways to do it, but you don't want to wait until it's too late. You don't want to wait until you're maybe sick. You don't want to wait until your business has passed its prime because you were sleeping at the wheel, hanging out at the country club, everything was great. Your employees aren't real happy. They're starting to leave. Your customers aren't real happy. You've got competition that's coming in and really making things difficult for you. So it's a conversation that should start today, no matter who you are, and you should start thinking about it and planning for it. And you should remain flexible because however you think about it today is probably not how it's going to happen ultimately.
That's a great advice, Dominic. I couldn't agree more. The longer the runway, the better. It gives you, more opportunities to get whatever issues you have into alignment because nothing's, no sale's ever perfect. And the more your house is in order, the better chances you have to get a better valuation.
Greg, I'll just chime in something that Andy probably knows better than everybody else on this panel. We have a saying when we do deals, and time is not your friend. Only bad things happen with time. And this COVID pandemic is a perfect example of why that is a true statement, because there were lots of people in the middle of deals, embarking on deals over Christmas, early part of this year. And, Andy's job as an investment banker is to drive the process. And oftentimes people will say, well, I don't understand. Why is he pushing so hard? Why does this have to happen tomorrow? What are all these false deadlines for? Well, this is a perfect example of why guys like Andy drive deals as fast as they can, because only bad things happen.
I think, I agree, Dominic, thanks for bringing that up. And it also speaks to how key preparation is. And that's like, preparing to go to market. Sometimes a client says, I want to go, let's go now. But you don't want to skip over all of the necessary preparation that needs to take place, making sure you're all set from a tax standpoint. One of the deals that we expected to close in the middle of March would have closed in February, probably the middle of February. But we ended up having a bad S corp with our company, so we had to go through a whole reorganization of the company, an F reorg, to work around that. That took several weeks, and by the time we were ready to go, middle of March, boom, COVID hit. Now we're delayed because of that. So it's a great example, Dominic, to your point. So even private, small private companies, even if you have audited financial statements, a quality of earnings analysis is critical, because it is absolutely coming. It's coming on the other side. It's come down on us. I'm seeing every corporate, every sponsor-owned company, every sponsor looking at a company on a standalone basis, hiring a buy-side Q of E firm to do the work. So it's coming. So, it behooves you as a seller to have your expert lined up ahead of time, and to have that work, to have the sell side Q of E work done ahead of time. Because again, preparation is key to making sure you don't have any surprises that come up during the process, and B, any delays related to surprises or other factors. Because as Dominic mentioned, time is not your friend. You want to get in and out of the market and do a closing as rapidly as possible. And
so Brandon, can you add to that?
All your experts, not just investment banking, but having really strong legal counsel with a ton of M&A experience, third-party accounting, and in some cases, make sure you've got, all of your IP buttoned up, so there's no issues there. I mean, you can go on, but preparation is the key.
Sorry to speak over you, Andy. Brandon, I'm imagining you have a few war stories down that line. So.
Yeah, it's like, it's a bummer to share some of these stories in this day and time, but I think it's important to kind of learn from these. But to kind of add on to what Dominic and Andy have started is, we're dealing with a local business owner here, great business, right? Pre-COVID, great cash, great business model, opportunity to continue to scale on a national level. And then the pandemic hit. This is a guy that built something from nothing, right? Him and his wife started this here in the area and turned it into a tremendous thing. But back to Dominic's point, they dragged their feet for like 2 or 3 years, and they finally decided to kind of start moving forward, kind of right around the beginning of the year, and they just couldn't get everything aligned and ready. And then everything hit, and the business owner, he wants to go, because now he's worried about potential administration and political effects, obviously, with a potential change here in Washington, and he wants to get a deal done. And the investment banker and us, and it's a big education process as well, because we're doing the sell side Q of E. There's a lot of things in terms of just the bookkeeping that just needs to be taken care of, because it's a mess. And trying to get that up and ready, like, we can understand it, but a potential buyer is going to come in, and on top of operational issues, there's got some stuff housekeeping wise that just raise additional questions. One approach we take is no surprises with any type of work that we do, and especially in this area, you really want to flush out all those skeletons. So whether it be tax issues, environmental issues, legal issues, just general accounting matters, it's so important to kind of, again, prepare, plan, prepare, and perform from that standpoint. And that education and giving yourself enough runway is so important. So.
No, I couldn't agree more. And the amazing thing is, you can start now, and if you've got years to get your accounting and other things cleaned up, you don't have to do it with a gun to your head, and you can do things right, and you can flush out some tax issues and things like that may actually mess up your deal at the end. There's people that might react badly to that kind of a surprise. So you want to do your Q of E as early as you can.
No, I was just going to say, just like my wife won't let me go shopping when I'm hungry, the same thing kind of when you're doing the deal wise. Make sure, obviously, you're getting everything in order, and you give yourself that runway so you don't have to make an ill-advised decision. You can be sound in your decision making throughout that process.
Great. So we've got I've got another really good question here, and this one's squarely in Andy's backyard, because I've been told that private equity doesn't look at firms with less than 5 million in annual sales. Do you think there are size barriers to selling?
Yeah, I mean, I would say that, yeah, revenue is one metric. I think depending on the, are we're talking about private equity, are we talking about venture capital, are we talking about a traditional business, are we talking about, a SaaS business that's growing like a weed that's got 4 million of annual recurring revenue and losing money, to Dominic's point? I mean, that kind of business could have a significant valuation. Even though it's not making money and even though it's sub 5 million. But if you're looking at a traditional manufacturing, or consumer products based business, 5 million of revenue, yeah, it's on the small end. I would say the market is pretty shallow for private equity buyers that are looking for companies kind of sub 5 million of revenue, maybe, certainly sub $1 million of EBITDA. I mean, it is pretty shallow, but there's a lot of other entities. There's family offices. There are individual, high net worth folks that are out there, or executives that have built up some net worth that are looking to buy, operating businesses on the smaller side. So, part of it is just, sort of the network of your advisors and who they think, is out there that might be interested in the business. But I would agree with that point. I mean, if sub 5 million revenue business, the private equity market is pretty shallow. But as I said, there's a lot of buyers out there that don't look like private equity. They don't go raise third-party capital limited, from limited partners. They don't create a committed capital fund. They just have capital. They have access to capital, and there are many of those types of guys or folks that are buyers of these smaller kinds of businesses.
So, and just on that too, is if you're in that position, you may want to actually look towards an acquisition to get something to get into a larger audience, because the ideal thing, I think, and Andy, you can tell me if I'm right on or wrong on this, is once you get yourself over a certain amount at different steps, more and more businesses become interested in looking at your business. So if you've got if you're on the shallow end, $1-2 million of EBITDA, and you figure out ways, there's more than one way to get yourself up to 5. And
Yes.
when you're at 5, you're talking to a whole different.
Yeah, I would say that size definitely matters in M&A. I mean, you could have two businesses completely identical. One is, call it 2 million of EBITDA. The other is 15 of EBITDA, and the market value of those two businesses, even though they're in the same business, in terms of EBITDA multiples, is totally different. I mean, the bigger companies will go for more, and then you take that $15 million EBITDA and then you scale it up to 60 or 70 million of EBITDA. It steps up again, and there's a lot of reasons for that, but scale is important in M&A. And the other thing I would say, just on the acquisition front, I agree with everything that Dominic said. I think the most important thing, two things I would pass along. Number one, you got to make sure that your house is in order. Number one, you got to make sure your base company is running efficiently and effectively. And so it's really in order, so that you're looking for that next step of growth externally. Number two, you want to make sure you've got a lot of your own borrowing capacity on your own company. You've got additional borrowing capacity right now, because if you don't, and you're competing to buy other companies, you won't have any advantage over private equity or other buyers, right? The ability to borrow, to have additional liquidity just based on your base company is important to compete. And then finally, I'd just say, look, I mean, a bigger company it can be more valuable, but I would, size just for the sake of size isn't necessarily a strategy either. I think, having a clear strategy criteria and really being able to quantify in your own mind, what are the revenue and cost synergies you're trying to obtain by making a strategic acquisition? That's how you take 1 + 1 = 3, not 2, right? And so that's, those are the few things I would pass along.
Hey, great. Begin with the end in mind. Let's steal something from Mr. Covey. So we've got just a couple minutes left. Okay.
I would like to add to that, Greg, and just tell whoever asked that question about 5 million that, yeah, it's probably too small for institutional private money, private equity, but I probably know 20 guys who will look at that deal all day long, because, if your business makes $1 million, it makes $1 million. And there's a lot of people that that would like to that will pay for that, and they'll take that $1 million EBITDA all day long, either to grow it or tuck it into something else. They're going to get they potentially are going to get a better return on their investment than whatever their other options are. So I think the message is it's probably too small for institutional private equity, but it's definitely not too small to be attractive to a whole bunch of other people out there.
Yeah, there's a lot of people running around looking to buy companies. There's no question about that.
Absolutely. Great. Well, gentlemen, this has been a really good conversation. I know it was good because it's short. It seemed like less than an hour. So I appreciate the panelists. That was great insight from everybody. Robert has sent the link to the next set of sessions in the chat. So if you open up the chat, you can get it. You can find your way to the next areas. Thanks very much again to all the panelists. I really appreciate your time and your insight. And thanks everybody else who joined us.
Thanks, Greg, for moderating. Nice job.
It was an easy group to moderate. Great topic.